Fed raised rates very, very quickly in this cycle. Do you think there's a chance that they may move quickly on the cutting rates?
You're going to hate what I'm going to say in answer to your question. You're just going to do it. First, they don't have a clue. It doesn't matter what Jay Powell says he's going to do. He doesn't have a clue what he's going to do. And Milton Friedman said this when I was, very young. They're like children. We were talking about children 50 years ago. They're like children now driving bumper cars in an amusement park, and they can't take their hands off the wheel and the gas and the brake and bump into each other all the time and create all kind of chaos. And the fact of the matter is, they don't know what they're going to do. To try to anticipate what they're going to do also is stupid.
To all the viewers from the United States, Korea, and around the world, welcome to Global Money Talks, reporting from the floor of the New York Stock Exchange. I'm your host, Tai Wong, and you're watching SamPro-TV's special Global Launch Edition interview with Ken Fisher, the founder and executive chairman of Fisher Investments. Fisher Investments is a premier investment firm serving high net worth individuals, families, and institutional investors. Ken founded the firm in 1979, which now manages over $275 billion in assets. I'll start with something that's on everyone's mind right now. 2 weeks ago, the market woke up on a Monday in an absolute panic. But since then, to I think a lot of folks' surprise, an aggressive rally has brought the S&P back to within sights of all-time highs. So what are your thoughts here? Was that just, a nightmare for a day, or was that a signal of something a little that we should be more concerned about?
Well, said simply, I read somewhere, I'm aware that stocks are volatile, and whenever you get volatility, people forget that there's downside volatility and upside volatility. And they're both basically the same. They're just two sides of a coin. The reality of that period is starting in the middle of July. The countries that have been stronger, and the world market hit a strong peak in the middle of July. It largely plummeted. The South Korean market plummeted about 14%, U.S. market less, of course, but still almost 9% in just 14 trading days. And the fact of that is, by the time you got to the bottom, fears had arisen because downside volatility makes people give credibility to fears that they wouldn't have been without the volatility, and people were freaking out. And this is pretty normal inside a bull market. This is a bull market.
So I know that one of the quotes you like is, how your investments behave is a lot less crucial than how you behave. So I guess this is a perfect example of not to panic out at the bottom.
So let me put that differently. In finance theory, the only basis for making a trade is to somehow, some way believe you know something that pretty much most of the people don't know. And the reality is, most of the time, most all of us don't know that thing. And when we think we do, we really need to stop and say to ourselves, wait a second, do I really know something other people don't know, or am I reacting to the same stuff everybody else is reacting to? Because if you are, that's pretty much already been priced, because what stocks do is to price all widely known information. They do it pretty effectively. They do it better than most all of us can.
Do you have a target for the S&P 500 at for the end of the year? I know it's hard to predict, make a prediction, especially about the future. But what are you thinking about the end of the year for the S&P?
So I don't really know, but let me go back to what I said a moment ago. It's a bull market. Let me add a couple of more points. Presidential election years in the United States have been positive 83% of history in years. Since the beginning of accurate daily data in 1925 for the S&P 500, with a little over 11% average annual returns. When the first half of the year has been positive, the back half of the year has been positive 8 out of 9 times, and the one exception was 1948. The reality is, the back half is usually stronger than the first half by a good notch. There's a lot of uncertainty in the first half of the presidential election year. This year, probably less than most, because at the beginning of the year, most people widely presumed that it would be as an election, President Trump against President Biden, which then, of course, got upended in mid-July in almost perfect parallel to the one that followed. But uncertainty in an election year falls as you move toward the election. And we'll see that. And as that happens, stocks tend to like falling uncertainty, and that tends to be positive. Exact number? I don't know. I think it's arrogant to think an exact number for the market along the year. It ends the year, because stocks are volatile, 3, 4, 5% higher or lower. Nobody can really tell.
I'd like to lead into another thing that's on the market's mind is we have the Democratic National Convention going on starting yesterday. And what the election too close to call, I think a lot of investors are thinking, how would I trade a Trump victory versus a Harris triumph? Is there a trade if you felt very strongly about one side or the other?
I think, again, I'm going to go back to my prior point. You got to think you know something. Let me make a point about something I've written about for a long, long time, which is a thing I call the perverse inverse. And if you just look at the history of presidential elections by party and the outcome of the market in the election year versus the inaugural year, and mind you, by the time you get to the election year, just shy of 2 months away from the beginning of the inaugural year, the fact is that in years where we elect a Republican, simple fact, returns in the election year tend to be above average, but below average in the inaugural. In years in which we elect Democrats, returns tend to be lower in the election year, but flip-flop and be higher in the inaugural year. For example, Democrats have not had a negative first year of a president's term since Franklin Roosevelt, except for Jimmy Carter's negative 7.4% in 1987. Republicans have had a lot of down years in the inaugural year, but again, Republicans have higher election year returns, Democrats have lower election year returns. Why? The why, which is always hard to discern than the what, is largely, in my opinion, because people tend to generally presume that the Republican is more business-friendly, pro-capitalism, anti-regulation, all that stuff. The Democrat is generally presumed to be a little like Democrats say, more anti-business, particularly anti-big business, more pro-regulatory, et cetera. So in the election year, people fear what the Democrat will do. They get hopeful if they think the Republican's going to win, thinking that'll be good for business and stocks, et cetera, et cetera. But the reality is, in the American system, you have a very complicated process that makes it almost always true that presidents can actually do a lot less than they promised during the campaign, no matter what it is. And that will be true for former President Trump or Vice President Harris, whoever is elected. And that is particularly true in a time like the time we will have ahead, where regardless of whether the Democrats keep the Senate or lose it to the Republicans, nobody will have a very big margin in the Senate, neither Republican nor Democrat. And the same is true in the House of Representatives. There's just not enough House of Representatives that can flip, and we can talk about those congressional elections, but neither of these two aspirants will be able to do nearly as much as they promised in their campaign, because for the most part, most things that are really big and really important, they have to pass through Congress. And even then, it has to stand challenge of the courts. And the American system is set up that way to make things slower and cumbersome and more resistant to rapid governmental change. And so in the inaugural year, the Democrat can't do as much as some people feared. The Republican can't do as much as some people hoped. So the hopes that were in the election year for the Republican are disappointing in the inaugural year. The exact reverse is true for the Democrats, where the fear they were doing things, including, for example, Vice President Harris has said she wants to raise the corporate tax rate. Well, maybe, but raising the corporate tax rate isn't something she can do. It's something you have to pass through Congress. And Congress is going to be a very tight one, regardless of who wins in the congressional elections. Nobody's going to have overwhelming power.
That's a great point. it's almost as if we have to trade the expectations. If you get a Democratic victory, you may be able to buy the dip somewhere in between the election and the beginning of next year. Alternatively, if the former President Trump were to win, if there are places that you want to take a little profit, it might be time to take a profit and perhaps reload a little later. But you do run into the risk that you're out of the market for perhaps some of the best days of the market. But that is really a great point, and I'm glad you highlighted that. So, would you think that the republic is safer if we had a divided Congress, where at least one house of Congress is held by the opposition to the president, in terms of, you could say, then the government can do less damage? Is the best thing for the market a divided government?
First, I'm not 100% sure what the definition of safer includes, but in terms of stocks, there's a very long history that I've pointed to for a very long time that indicates that markets, particularly stock markets, like gridlock. They like it when government can't do much. Fundamentally, as behavioralism teaches, people hate losses more than they like gains. That's less true in America, let's say, than it is in Europe. Europeans are much more loss averse than Americans are. But the fact of the matter is, because people hate losses more than they love gains, big governmental changes make people fear the impact against them more than they love the potential for gain from something the government might do. And in that, big government change creates chaos, raising uncertainty, increasing the fear of potential loss to somebody who hates it more than whoever might win loves it. And the reality of a very stable government is capitalism, the ability to wiggle around to some extent whatever rules exist that government has imposed. So if you think through all the things that have gone on in recent years, capitalism has had plenty of time to adjust to them, to start changing things this way, that way, the other way, and then capitalism has to adjust to them all again.
So I guess we will hope that the election results in a government that the founders planned for, something that works slowly and you don't have a lot of quick change and ill-considered volatility. Moving along to later this week, we have Jackson Hole, the central banks are meeting right now, but Chair Powell has a key speech on Friday. What do you think, what kind of signal do you think we'll get out of Chair Powell and Jackson Hole? Will they signal a single cut in September or a series of cuts to follow thereafter? I mean, the Fed raised rates very, very quickly in this cycle. Do you think there's a chance that they may move quickly on the cutting rates?
You're going to hate what I'm going to say in answer to your question. You're just going to hate it. Central bankers be crazy. Never, ever, ever worry about whatever they may or may not do, because first, they don't have a clue. It doesn't matter what Jay Powell says he's going to do. He doesn't have a clue what he's going to do. They never have a clue what they're going to do. Not just the Fed, but central bankers, Bank of England, the Euro Bank, you can go on and on with this. Let me just make a point. You cite, and correctly so, that they raised rates pretty quickly this time. I want to point out that in May of 2022, Jay Powell openly said, we are not even considering a 0.75% or 1%, 75 basis point rate hike. In June, they did 75 basis points. They did 75 basis points again, 4 more times, month after month, skipping the month of October, probably because it was American Halloween and they didn't want to scare people too much, and then resuming again. And the fact of the matter is, they don't know what they're going to do. To try to anticipate what they're going to do also is stupid. And let me make the point why. Think through, Jay Powell started that process with the Federal Reserve Board in June of 2022. By the time you get to October of 22, the market already hit bottom, was soon well above where it was when he started, while they're still raising rates. Market bottom during that Halloween period I was talking about earlier. The fact of the matter is, well, just a little before Halloween. The fact of the matter is, the gets, and you can see the same thing in European market. You can see the same thing in the rate movements that the Bank of England did. The fact of the matter is, if all those rates in the bull market that happened without any kind of recession on a global basis is what you get out of rate hikes, who needs cuts when you got hikes like those? The fact is, there is no good history. People don't want to believe this. They just don't want to do it. But there is no good history to indicate there's efficacy in A, being able to predict what central banks will do, or B, if you could predict what central banks would do, that would predict what stocks would do. There's no data there to support that. People just have an inherent bias that believes higher rates bad, lower rates good. We want this. That over there is bad. And the fact is, just said simply, it's all fruitcakes. Paying attention to what Jay Powell thinks or what he says he will do, the whole notion of forward guidance, that they flop more often than they don't. And paying attention is wrong. And if you could, it wouldn't make much difference because there's not an efficacy between what happens to rates and then what happens to stocks. People don't want to hear that, but it's true.
I think Jay Powell just crossed you off this Christmas card list.
Jay Powell crossed me off his Christmas card list. I mean, I was crossed off the Christmas card list when Arthur Burns was head of the Fed.
And we remember Arthur Burns simply because he let inflation get out of control. And I suspect that Jay Powell doesn't want 50 years from now school children to be talking about Jay Powell and how he let inflation out of control. I wonder if the Federal Reserve and perhaps agencies like it work from the idea of the path of least embarrassment. Let's not get caught. We were caught out once. Let's not get caught out again.
So you don't want to get me started talking on the Fed. You already did. I could just keep going down that rabbit hole for so long. The fact of the matter is, what I said in my first few words is right. Central bankers be crazy. The only thing that they should do, which they won't, and Milton Friedman said this when I was a very young man, is that they're like children. We were talking about children 50 years ago. They're like children now driving bumper cars in an amusement park, and they can't take their hands off the wheel and the gas and the brake and bump into each other all the time and create all kind of chaos. Particularly chaos when they use forward guidance and then don't do what they said they do. And the fact of the matter is, said simply, because they don't know what they'll do and because they react more than they cause, the simple feature is they don't know if they're going to embarrass themselves or not. I mentioned Arthur Burns. Arthur Burns was head of the Fed appointed by Richard Nixon for 8 years, starting in 69. And was thought to be best trained head of the Fed ever up to that point in time. He replaced William E. Chesney Martin, who was the longest serving head of the Fed ever from 1952 until 1921. And William E. Chesney Martin said, when you're head of the Fed, you take a little pill and it makes you forget everything you ever knew, and it lasts just as long as you're head of the Fed. And then, as you said, Arthur Burns let inflation get out of the bag, and then he helped cause recession, trying to react to it. Without knowing what he was doing. And they asked Arthur Burns afterwards, you were trained not to do all this stuff. Why'd you do it? And he said, well, I took Martin's pill, which, is kind of humorous.
That's a great story. Staying with the Fed for a little bit, but more their their mandate. Do you think a 2% inflation target that apparently originally came out of the Central Bank of the Royal Reserve Bank of New Zealand, we spent years trying to hit that target and couldn't, and now we're trying to get back to it from the other way. Is that the right inflation target? And if not, what should it be? Should it be higher? Should it be 3%?
So let me go back to my prior point. Central bankers be crazy. There is no right number to people. The reality is 2% is a perfectly fine number if they stay stable with that, which I seriously doubt they'll do because they can't keep doing the bumper car thing. They got to keep bumper car. The Bank of Korea has a much more rational approach to life than the U.S. Fed does. As you know, and I'm not sure if all South Korean viewers know, but Fed has a dual mandate created by the Humphrey Hawkins Act, where they're supposed to create price stability and stable employment, economic stability, otherwise, in GDP growth. And the fact of the matter is, they've really only got one tool to do two things with, and therefore they can't really accomplish both at the same time. The Bank of Korea really only has one mandate, which is price stability, and so therefore it's easier to accomplish. But even there, the reality is a lot of the things that they believe cause inflation don't, and a lot of the things that they don't think cause inflation do. So they end up doing stupid stuff. They always end up doing stupid stuff. But there's no right number that
You're a fan of moving to a single mandate.
This is the right amount of inflation to have. There's no such thing as the right amount of. Why not set the right amount of inflation at zero? That'd be just as rational.
Some people would argue a 0% inflation. What are all these folks with mortgages going to do? They're hoping that they pay it back with cheaper dollars later in the future.
And let me go to a different point. Whenever you wiggle things one way or another, somebody's helped, somebody's hurt. The reality is that's always true. You raise inflation, you lower inflation. These people are hurt, those people are helped. The fact of the matter is, the best thing they could do is just, and I don't care if it's 2%, not 2% doesn't bother me, but pick a number and be consistent with it in the long term, which they have a really hard time doing. Let me point out that we wouldn't have had the inflation surge that we had starting globally in February of 2021 if in reaction to COVID, the central banks of the world, the big central banks of the world, hadn't done a lot of stupid stuff creating excess quantity of money. That's what caused the inflation. They caused the inflation, and then after that, they try to take it down. I can't tell you how stupid them doing that was. Let me just speak to that for a moment. I can't tell you adequately in the amount of time we have. To make it very, very short, we got the economy locked down in 2020, and they start creating money thinking that's a good idea in huge volume. Now think about that. The economy's locked down. What you going to do with money? Well, the economy's locked down. What you going to do with money? Start an inflation cycle. Too much money chasing too few goods. Real simple.
Moving to a sort of a broader question. You've been a keen observer and a student of markets. You've written 11 books. You had a weekly column for Forbes for 33 years. I'm looking for your insight on some broader questions about stock market valuation. So, for decades, the average annual return of the S&P has beaten, usually quite substantially, the rate of U.S. GDP growth. Is that sustainable over the long term, that the economy is growing at perhaps between 2 and 3%, but you have the S&P gaining perhaps 7% on average over some number of years or even decades? Is that sustainable?
Well, let me answer your question two ways. It's a valid question. It speaks to the issue of what's the logic about relative valuations. Think it through for a second. First, to your question, what you have said has been going on now measurably for 100 years. Therefore, in the long term, it has been sustainable. Your question further was implied to be, is it sustainable into the future? Let me see if I can speak to that in a way that I don't think most people think about. My grandfather was born in San Francisco, California in 1875. If you look at the way his grandparents lived their lives, his grandparents lived their lives exactly the same as their grandparents would have lived their lives. No material difference. The fact of the matter is, the Industrial Revolution, starting in Britain and then followed by the American Industrial Revolution and rippling around the world, created a world in that period when my grandfather was a child where people would never live their lives again the same way their grandparents did. My grandfather, who died in 1958, could sit in his living room before he died and see the President of the United States real time on a little box in his living room called a television set that his grandfather could never have conceived of when my grandfather was old. What is that? It's the power of capitalism to create never yet done, better, different things that increase the wealth for everyone, which accrues to the value of capitalism. My father's generation, he was born in 1907, saw more absolute change than my grandfather saw, but less relative change. I, in my 70s now, born in 1950, same time as the Bank of Korea was born, my life has seen even more absolute change than my father's and my grandfather's, but less absolute change, but less relative change, excuse me, than either. Now, to that point, let me just say that when you create something like this, that my father never really ever could have conceived of, it adds wealth beyond the level of GDP growth because it provides benefit beyond the level of GDP growth. And in my 73 years of life, a kitchen doesn't look at all like a kitchen used to look. It's not just the stuff, it's all the things that go with the stuff that benefit it. I do believe that as long as science and technology keep coming up with new, different, and better in market ways over fairly long time periods, like 10, 20 years, you'll keep seeing that spread in valuations that has existed, in valuation between GDP growth and growth in the value of the broad stock market, domestically and globally, that has been true in America for over 100 years.
I have a follow-up to that, and I found this recent website called Visual Capitalist, and they have some wonderful illustrations. And an illustration that I saw recently is they said that they looked at stock market capitalization as a percentage of total in the world. The United States is, they said, about 60% of the world's total stock market capitalization. The U.S. economy, though, is only about a quarter. Is that because we're the best at capitalism?
It's because we're the best, America's the best at technology. The best at combining technology with capitalism. The reason that the U.S. stock market has done better than the non-U.S. stock market in recent years is because not 100%, but 85% on a global basis, all of the leading tech companies are in America. If you look, for example, at the 50 largest tech companies in the world, 3 of them are in Europe, a handful of them are in Asia, and the rest of them, 38 of them, are in the United States of America. It's that same thing I'm talking about, just a little different. The fact of the matter is, if you look, and I'm going to say this really simply, because people are very myopic. They have a hard time seeing much into the future, and they have a hard time remembering how things really work. But if you go back and you look at, let's say, in the United States or on a global basis, it doesn't matter to me, the 40 largest stocks, say when I first came into this world of investing around 1970, and then look at the 40 largest 10 years later and 20 years later and 30 years later and 40 years later. 20 years later, invariably, most of them have changed to new ones. But that first list would have included Xerox, Polaroid, General Motors, Sears Roebuck, AT&T. Would have included IBM that's still around, and AT&T is still around, but they're way down the size spectrum. General Motors still around, way down the size spectrum. But every 20 years, they keep changing. If you look 20 years ago, 15 of the companies that are on the 20 largest now weren't even doing anything then. So my point being, this process is what I call, the active capitalistic creative destruction, where the big, dominant, growth-oriented companies slow down, rusticate, become more self-centered, and they, having been the hunters, become the hunted, and new technology companies or other growth-oriented companies come along to eat their lunch and do, and then they 20 years later themselves become the hunters. It goes on and on. It never stops. It's been going on all of my life. This creative destruction, which is a phrase that Schumpeter created once upon a time, is actually real, and you can measure it in the stock market, but it translates into that part where America, to your basic question, does a better job of combining technology with innovative entrepreneurial capitalism to create new companies that dominate and do never yet done things that change the world.
Let's follow that a little bit more, because it's a fascinating answer to the question. What can we do to ensure that the advancements in technology and the appropriate creative destruction continues to take place? Or perhaps another way of answering is, what should we not do legislatively or by way of regulation or in some other way to stop this sort of sometimes painful but overall virtuous process from continuing?
But capitalism is really good at wiggling around stupid stuff that governments do. If it has half a chance, if the stupid stuff isn't too heavy. All you got to do to make humans a lot better off 30 years from now than they are today is have the government do nothing. Is that going to happen? No, the government's going to do stuff. The more we can keep the government from doing much, the more capitalism will keep coming up with crazy ideas that no government would ever think would work. I mean, if you just think about all of the companies, whether it's Facebook, Google, Amazon, the Magnificent Seven type companies of recent years, no government person would have ever thought, boy, oh boy, this is what's going to work. And government-funded projects typically don't. And the best thing that can be done, said simply, is don't try to fix capitalism. Capitalism doesn't need to be fixed. Now, in the meantime, you do get all kind of things people don't like. Japan is hugely regarded for its employment stability. But if you look at Japan's growth, either in the stock market or in its economy over the last 30 years, that stability that it has institutionally embedded in itself, because it doesn't have that creative destruction process that exists in the American system, and actually exists pretty well in South Korea. It doesn't exist in a lot of places in the world. The best thing that can go on is to let capitalism keep doing what it's doing. In the short term, it creates disruption that people don't like. And the fact is, that's been going on forever. But on the other hand, if you stop it, you get the stagnation that you see in Japan. Effectively, as you try to stop it by putting in this regulation, that regulation, this bright idea, that clever thing that the government thinks it's going to do, all these government people, whether they're Republicans or Democrats, think they know better. They think they know better than capitalism. You can hear that routinely out of Democrats' mouths, but you can also hear it out of the mouths of an awful lot of Republicans, where they think things have to be fixed because those businesses are doing bad. And, somebody like in America, Senator Marco Rubio and the other Republicans want to stop buybacks. They think it's bad. The more they want to fix stuff, the more they think they know better. Question you asked, what do we do or what do we not do? The best thing to do is let capitalism do its magic, because it's really good at it. Just be a little patient. Patience is a virtue.
Sounds like we need.
It's possible for most people.
It sounds like we need a Calvin Coolidge for the 21st century. It'll be about 100 years since Silent Cal was president, and thought he did a pretty good job. One follow-up.
Let me go on for a moment, if I might, Ty. Let me just go on.
Sure, absolutely.
We don't really need a Calvin Coolidge. We just need the government not to do too much stupid things. The fact of the matter is, from Cal Coolidge's time, we've had that 100 years that I was talking about. And in that time period of the 100 years, as things have created so many new things that have benefited so many people, I mean, every good thing any viewer has comes from something that came out of capitalism somehow, bar none. The fact said simply is, the government will do stuff. We just need them to not do too much that's too bad. We're not going to get a Cal Coolidge. We're not going to get a do nothing. But the more we can get it to not be too much and not too many. I mean, you take Vice President Harris's idea that she's going to try to regulate prices in the supermarket for food and other for groceries. These are very competitive realms with lots of different vendors. People don't have to eat this if they don't want to. They can eat that. It's all competitive from the buyer side. It's competitive from the seller side. The argument itself that you're going to regulate prices in supermarkets is just blatantly terrible, because the history of price controls, which has been imposed many times in the history of the world, never works. It always blows up. It always ends up being a bad, not a good. We just need to not do too much of that kind of stupid stuff.
A follow-up question, and I'd like to get your thoughts on it. I'm reading that the Department of Justice is considering whether they want to break up Google for being a monopoly and for being too powerful, and even Adam Smith, often considered the father of capitalism, said that perhaps monopolies could be difficult. Do you think that anti-monopolist leaning, let me rephrase that. Do you think the government should be in the business of making sure that monopolies don't happen, or should they let the capitalist system deal with that? That somebody will come along and dethrone Google in 10 or 20 years' time.
The fact of the matter is, we have this long history. Who would have ever thought, once upon a time, Eastman Kodak had a near monopoly on photographic film in the United States of America, and photo finishing, for that matter. You got so many entities that had. I mean, they all get their Xerox own the copier business. They all get their lunches by becoming the hunted, as they get complacent, self-centered, and think they're the center of the world. Who will come up with the crazy idea to dethrone them? I don't know. This stuff dethroned AT&T. Who would have ever thought that when I was a young guy in the investment business? The reality is, who would have thought who would be the right people to do it? Mini computers toppled IBM. Personal computers toppled mini computer companies. It never stops. Google will get dethroned. Exactly by who and exactly how long it takes, I don't really know. I'm not suggesting Google will disappear out of business completely, but they'll go way down the rankings in power and market share with a little bit of time meaning 10, 15, 20, 25 years at the most. And when the government breaks things up, there's no real sense that they actually have a clue what they're doing. Try to find me some good examples of things that they've actually broken up where we've benefited from that. Stupid idea. I get, however, that governments intuitively think they know what to do and they think it'll be good. And there's a lot of people that scream about this stuff, and you don't have to use Google right now. There's other search engines you can use if you want. Somehow, sometime, some way, people will come up with something better and not Google.
Shifting focus a little bit, we have a lot of international viewers, and for people who say, or even Americans who want to diversify from the U.S. market, are there specific international markets that you like more than others? That if you wanted to take 10 or 20% of your portfolio and put it in India or Korea, just throwing out some names, do you have international markets that that you like more than others?
So first, I always think globally. I tend to want to run money not against the U.S. market, but against the world market, which tends to act with a high correlation to the U.S. market. But in terms of portfolio management, one of the biggest mistakes that people can make is to be sufficiently arrogant as to think they actually know and put effectively their bets on what they believe will happen. The way you're supposed to manage portfolios in terms of portfolio theory, which is often articulated in jargon that I'm not going to waste your viewers' time on. You should think sort of like this. Here's what I think is going to happen. So this is what I'm going to buy. But then I know I might be wrong. So if that stuff doesn't do well, but instead does badly, what would then be what would do well and own a significantly smaller amount of that? That is the core of diversification and portfolio theory. not spreading your chips around, but having a strategy and a counter strategy that offsets if your core strategy does badly. It's very, very simple. So when you think of that, you say to yourself, most people intuitively prefer their home country stocks. They're familiar with them. It's often easier for them to trade them. But in my opinion, the best thing to think is globally first. Think of something like the Morgan Stanley Acqui that includes, pretty much everything on a calculated basis of any significance. And then say to yourself, where do I overweight? Where do I underweight? So from my vantage point, right off the top, you underweight the countries that inherently are just sort of, if you will, down on capitalism. And then you look around the rest of the world and you try to offset, for example, if you're keen on tech, which has been doing really well in this, I think, for obvious reasons, and obviously so, you're getting most of your tech and most of your best tech out of the United States. So when you look overseas, you're not wanting to get more tech. When you're looking overseas, you're saying to yourself, what would do well if tech doesn't do well? The same is true if your view was tech's going to do badly. Well, if tech's going to do badly, you're going to be underweight in the United States naturally. And then you say, yes, what would do well then? And, oh, by the way, you still need to offset that with some tech anyway, even though I think tech's would do badly, because I know that what I think will do well might not, and if it doesn't, then tech will do well. This is the way you're supposed to think. The fact of the matter is, at this point in time, I'm actually optimistic on all kinds of parts of the world, including the core of Europe, which is doing better than people think of, including, you mentioned India. I think India is doing just great, including stocks in the Middle East, particularly the Kingdom of Saudi Arabia. I think all of these fit in, but it's really based on what's the sector they're strong on, what do they do well, and how does that fit into this notion of core strategy?
And a final question, and sometimes I'm a little hesitant to go out on maybe a down note, but as you look forward the next 5 years, are there certain clouds on the horizon, whether in the United States or geopolitically, or certain trends, whether they're like population declines or things like that make you worried that the next 20 years won't be as good as the last 20 years, if we just want to say it broadly? What keeps you up at night, if there's anything?
When I was very young, I learned not to let anything keep me up at night. Think about that differently. Let's say you were a wartime battlefield general, commander. You don't want to lose sleep the night before the battle because you need to be sharp the next day. Worrying about stuff when it's time to go to sleep is something you train out of yourself so that you're good the next day. I also never have made I got a long written history, publicly documented through books. I write columns in leading newspapers and magazines in 25 different countries every month. I've been writing for a long time, making all kind of prognostications, but I never have made long-term forecasts about what I think would happen 5 or 10 years from now with any kind of specificity, other than that capitalism will roll on, other than that we'll keep getting new, different, never yet done, better things that didn't exist before. And the process of that will keep going as it has, irregularly, with volatility and with bear markets over the course of the future as it has been. The fact is, the next 5 years, I don't know, because it all depends when the bear market hits. Is a bear market going on now? No. Is it about to go on very soon? No. Could one start next year? Come back and talk to me about it next year, and I'll tell you if I see anything there. But I never make forecasts ever longer than a year into the future. Never have. The fact is, I'm not worried about the things that most people worry about. And let me explain exactly. The stock market is a discounter of all widely known information. It prices, as best as can be done, everything we all talk about, think about. People can debate at parties or dinners And therefore, because it's good at doing that, that's what it does. What you should worry about are the things other people don't worry about, not the things that everybody worries about. So you can rattle off, you cited demographics. People have been worrying about demographics all my life, and it's never come home to roost anymore. People worry about too much debt. They always do. They always have. Someday it might come home to roost, but it's not going to come home to anything soon. Why? Because we know people worry about it. Once people worry about it, it won't in the marketplace. The stock market prices all that really well, and people cannot get over their own egos in thinking that they know better than the market in those ways. The fact said simply is, you can go down. Another common one that people talk about all the time is, what happens if the dollar loses its reserve currency? Well, first, I don't think that's very likely, but if it were to happen, it wouldn't have hardly any impact at all. Let me say that again, hardly any impact at all. But the fact that everybody worries about it tells you don't have to. When they're worrying, thank them. Send them a little card. Thank you for worrying for me. You make it so I don't have to worry. Thank you very much. You should worry about things other people don't worry about. And I don't see right now a whole lot of stuff to worry about that's really very terrible. Thank you for having me on, Ty. I do very much appreciate it.
Thank you. Thank you for an optimistic answer to my last question. Thank you for your time. It was really have a great talking to you.
It was great to be with you, Ty. Hopefully we can do it again sometime.